Ajay Vora is with us, Head of Equities at Nuvama Asset Management. Ajay, great to have you with us here. Thank you very much for your time. I want to start by putting out a chart which you've sent over to us, just to establish the chart and ask you to kind of talk about it. So let's just put this up. What Ajay wants to talk about is the MSCI emerging market chart, which is the sort of pink line on the screen, and the green one is the US 10-year Treasury yield. And I think the graphic is pretty self-explanatory. Whenever the 10-year spikes, emerging market, the MSCI emerging market benchmark sells off. This is all the way from March 2022. It's exactly inversely related with the US 10-year. And as you can see, with the 10-year rising, the MSCI emerging market has been plunging. Ajay, so the chart is established. It's on the screen. What do we make of what the market wants to do from here? Will we have to kind of foretell what the US 10-year is going to do to kind of decipher what the market here will do? That's tough. But what's your sense?
Yeah, so thanks a lot, Prashant, for having me on the show. So the only reason, why this chart is extremely important is, personally, I feel that it's very clear that, our markets are likely to stay in this range for some more time. And I think that's what we discussed last time as well. 2-3 months back, there was a consensus view globally as well that the interest rates have maybe peaked and therefore the inflation will come off, and say therefore, the market should start rallying. But over last, 1 or 2 months, that view has been negated because of the overall core CPI data as well as the strong employment data in US. And therefore, we have seen this 10-year rising again from 3.3 levels to 4% now. So the point is that, whenever you have this kind of an environment where it is established that the interest rates are likely to stay higher, it is unlikely that most of the markets would have a valuation expansion. And the same applies to our markets as well, because if you look at, how we have been in this range for almost now 18 months, actually. So October 21, we hit a high of 18,500. And we are in March 23, so we are still 5% lower from those levels. So the best part is that we haven't collapsed as such, broadly because of the domestic flows and also no major earnings downgrade. But post-festive season, which is like from November 22 onwards, we have been seeing a reasonable slowdown on the discretionary side. And I think market is taking its own time to see where this slowdown extends and settles down, and therefore the magnitude of the earnings downgrade. So my sense is that globally, higher interest rates, and locally, till we see this overall slowdown settling in, we will stay in this range, except for the technical factors. There cannot be a significant reason for markets to rally sharply. And why I say technical, because as you rightly mentioned just a few minutes back, that we have been taking support somewhere around 200 DMA at around 17,350. And if you look at the positioning as well, the FI positioning again is at all-time high of around 13,000 crore short, around 130,000 contracts. So that needs some adjustment, so which is taking place, and we are taking a decent support from there. But broadly, I think the range is here to stay for some more time.
Ajay, we're making very, very valid points. We have earnings, a bit of an earnings hurdle that we have seen in the past quarter as well. Earnings weren't really up to expectations, but there is risk on the downside. And then you have this El Nino that's, that's suddenly come to fore as well. So let's see how this goes. But, sometimes these markets, when they're a little bit jittery, they give you good buying opportunities. So let me ask you about the banking space. You have been fairly positive out there. That's seen the hardest knock. Last couple of days, it's bounced back quite well. What would you buy from the banking pack? Would it be the private sector banks, the large ones, or some of these PSU banks as well, still offering great value?
So, Nigel, on banking, I strongly feel that there is nothing wrong with the banking sector with us right now. And we are going through a similar phase what we saw in Jan to June last year. At that time also, we were looking at fairly strong numbers going forward. But because of the FI selling, the sector was underperforming big time. And I think over last 2-3 months, again, it is the same reason. And we all saw the strong numbers in Q3, which most of the private banks reported significant margin expansion, a healthy credit growth, benign asset quality. So fundamentals are very much in place. It's only that, this is what FI owns in a big quantity, and therefore, their selling will continue to put some pressure. Let me just give you, one important data. You'll be surprised that, say, suppose, Nifty CAGR over last 5 years has been around 11-12%, and Bank Nifty CAGR over last 5 years has been 10%. So within the large cap private banks, except for ICICI and SBI, all other private sector banks, the 5-year CAGR has been less than 12%. So you can imagine the fundamentals have improved significantly over last 5 years for all these banks. But actually, if you look at the market performance, it has been quite subpar and very ordinary. So my sense is that, we have gone through this period of around $60 billion of outflow in 2 years from FIs, 36 billion last year and 24 billion this year, which has led to a sharp, I would say, a significant overhang on the banking stocks. Once we clear this, maybe a couple of quarters from now, because of maybe, whenever the Fed changes their stance or whenever the selling abates, we'll see a decent performance from all these banks. So therefore, we continue to stay bullish on the banks.
Okay, so bullish on the banks. Ajay, let me not ask you about a sector now, but let me ask you about a theme. I've been just remembering a conversation I had today earlier with a company that's about to list, Dev Talk, the new IPO that's opening out. My question is very simple. I mean, A, would you look to play this Go Green theme? And if yes, then through what kind of companies? I mean, on the auto side, we remember what's happening to this company Electra, right? Last couple of days with their hydrogen buses, and now you have this new entrant, and Degvi told us they want to be pretty big in the EV space when it comes to transmission systems. So if you're looking to play the theme of Go Green, then what part of the cycle or what part of things would you really target?
So Survi, actually, if you remember, we all have seen this movie n number of times over last so many years. Whenever a particular IPO theme is coming up with, or, many larger companies are getting listed in a new space, people do get excited. But the point is that, although the opportunity size may be very big, but the gestation period and the profitability both will take a lot of time. So we have always maintained an approach over last 2-3 years, including all the newly listed companies as well, that it is important that the valuation has to be in line with what the earnings are. And considering the EV or the green, the theme what you're talking about, actually if you look at it, the profitability and the cash flow are fairly low versus the valuation these guys are commanding. So we would continue to.
So no, Ajay, I didn't mean it only in terms of a fresh IPO thematic play. I meant in general. I mean, you could look at a Tata Motors as well. You could look at a capital goods company for that matter, or maybe a Reliance. I mean, if you think the existing listed players are a better bet.
Yeah, agreed. So the point is that we are excited about the businesses which are already established and trying to participate in a much bigger theme. So we are positive on the entire cap goods space. And just to give you an example, we all saw how the tendering has taken place from the railways. The size of the tenders, the opportunity, and the growth visibility which these kind of tender gives you is something what excites us. So we are pretty much positive on this whole cap goods infra space. And although the valuations may look very unreasonable right now, but that is the whole opportunity and theme. If India wants to move from, say, $3.5 trillion economy to, say, $7, $8, $10 trillion, these are actually the companies which will end up benefiting from significant order inflows. And as we move forward, investors will get a lot of confidence on their execution capabilities as well. So it's a long gestation period, but at least there is certainty of execution, profitability, cash flows, and valuations may be high, but that can stay high because the growth is pretty much, very high. So that is a theme where we are reasonably positive.
All right. Ajay, it's a pleasure and a good conversation as always here on CNBC TV 18. I hope to speak with you soon again. Thanks indeed. That's Ajay of Nuvama Asset Management with thoughts on the market. Now let's